Good evening, viewers, and you're watching the Mortgage Busters show, and we're all about helping you pay down your mortgage as quickly as possible so you can get the title of your property into your own hands. My name's Greg.
I'm Adrian.
And we are the Mortgage Busters show. Adrian, the 1,000-day Mortgage Busters challenge.
Insane.
It has gone insane. We've got people ringing us on our mobiles, ringing us on our 1300 number, coming
Every
to
show.
us on the
And the
every show.
repeats.
Yeah, the repeats. Yeah, the repeats are working for us too. So, you know, if you don't know about the 1,000-day Mortgage Buster Challenge, go to our website, check it out. We challenge you to pay your mortgage down in record time, hopefully under 1,000 days. We'll do the best we can to put you into a plan to make that happen for you. 1,000 days.
Yeah. Well, 1300 TMB show.
1300 TMB show. Now, our first guest today
Another
is
guru.
Dale Sinnott, and he is another guru. He's an accounting guru. He's from Larkin Partners in Kew, Larkin Partners Accountants. Dale, welcome to the show.
Thank you, Greg. Thank you, Adrian, for inviting me.
It's our absolute pleasure. Look, as you know, this is the Mortgage Busters show, and we're all about helping people pay down their mortgages. But, you know, why do people get mortgages in the first place? They do so mainly to purchase property. And, you know, we talk to people about mortgages, we talk to people about investments, and property is one of the most popular types of investing, as you know. And people know the terms negative gearing, positive gearing, but, you know, in my experience, they know these terms, but they don't understand them. Can you help us with that?
Absolutely, Greg. And look, in simple format, I believe that negative gearing is where your rent is less than the expenses and interest and capital allowances or the outgoings of the property. So basically, there's a shortfall between the income and the expenses. And under the Australian taxation system, we're allowed to claim that shortfall offset against our income. So if you're in the 30% tax bracket, it means that 1/3 of that loss is coming back to you.
Well, so it's a good thing.
It's absolutely a good thing.
So negative gearing is positive.
We didn't say positive gearing. You just said positive.
It's a positive thing. So I say that to clients, you know, negative gearing is a positive
Well,
thing.
is.
It is, yeah.
You could actually use that funding, the money that goes into that. Instead of paying more tax, you pay less tax and you can get an investment.
And look, the fantastic thing about this is that the money you get back from the tax office, that helps you to meet that shortfall. So basically, if you've got a $100 shortfall every week, you're getting some money back from the tax office to meet that shortfall, so it lessens the financial impact on your budget.
Fantastic. Well, I mean, the government's good to us, so you have to say that.
Look, it's not only about the government, but what this is about, it's a long-term strategy for your financial independence.
Fantastic. So, in a nutshell, I've understood it. What comes in, what comes in from the property in terms of dollar value, and what goes out. The difference, if you're spending more than what you're receiving, it's a negative gearing.
Correct.
If you're getting in more than what you're spending, it's positive gearing.
Correct.
Okay, but a typical example would be a brand new, an investment property that's just been built brand new on 100% borrowing. That would be most probably negative geared.
Absolutely, and one of the things that will not only just make it negative gearing, but when you've got a brand new building, you also have a lot of write-offs in relation to the building write-off, which is a 2.5% write-off of the cost of the building, and a write-off of the cost of the fixtures and fittings over a time period, which is what we call a capital allowance or depreciation of the fixtures and fittings. So they form part of your purchase price, but they also become a deduction for you over a time period on your income tax return. We call them non-cash deductions because they're not actually physically costing you on a month-by-month basis because they form part of the purchase price of the property.
Understood.
And established? What about established?
Established properties, exactly the same thing.
It is the same?
Exactly. What we advise our clients to do is have a quantity surveyor go through the property after they've purchased it, and the quantity surveyor provides us with a report of what deductions we can claim for the building allowance and for the fixtures and fittings that are in that property. So they give us an estimate value of those items.
So that's probably a new term for a lot of our viewers. Quantity surveyor. Mm-hmm. What do they do?
A quantity surveyor is basically a person from an engineering or building background who goes in and basically physically inspects the property and values the fixtures and fittings in the property, looking at the age and the condition of those items, and also looking at the building when it was built and providing us the cost of his estimated cost of those building, and then providing us with a full report that is accepted by the ATO for us to claim a deduction on those items.
Okay, all right. So he's an expert in that field.
He is an expert, but they have to be registered by the ATO these days because they are providing taxation advice.
So that's only for the established or for both? Oh, for both.
Mhm.
Okay, good.
With a brand new property, quite often you can get the information direct from the builder because quite often they have to have the quantity surveyors report in relation to the occupancy of the building.
What about commercial property? Does that work the same way in positive, negative gearing and all that sort of thing?
Absolutely, absolutely. Look, gearing is a general term. It can work for shares, it can work for property, it can work for other investments. What gearing is, it's basically borrowing for income producing purposes and the expenses are greater than the income that's coming in. That is gearing.
Right.
So it's not just for property, but it's for a whole range of investment purposes. But it's closely arranged to property because that's probably the safest area for us to borrow to buy into.
Yeah, correct. I would agree. So if there are any pitfalls that you see, what would you alert our viewers to? Like, is there a common problem that keeps reoccurring or?
Look, there's two probably pitfalls that we always advise our clients on. Number one is make sure that you do have a surplus income to be able to cover the shortfall that you are incurring on that property. So we know that your rent and your outgoings, that there's a shortfall, you need to contribute to that shortfall. So you need to have the ability to contribute to that shortfall, and you also need to have that ability that if there is a problem, that for some unknown reason the property is not rented for a month or 2 months, that you've got the ability to cover the outgoings on the property whilst you're not producing income from it.
So having a buffer in place.
Correct.
Dale, we have to go to a break, but we'll come back.
No problems.
Thanks for watching Mortgage Busters. We'll be back after the break. Welcome back, viewers. You're watching the Mortgage Busters show, and we're with Dale Sinnott from Larkin Partners Accountants in Kew. That's a mouthful, isn't it?
It certainly is, Greg.
Okay, Dale. So we've got positive gearing and negative gearing, and that's just however it works out. You've got expenses. If you've got an investment, let's consider an investment property. You've got a mortgage on an investment property. You've got to pay interest on the mortgage. You've got rental expenses around that property. That's all outgoing, but you've got a rent coming in from the property, and you've got all your deductions. So that's incoming. If the outgoing is more than the incoming, that's a negative gearing.
Correct.
And if it's the other way around, it's positive gearing.
Correct.
Very good.
And in our perfect accounting world, we would like all of our clients to have positive geared properties because they're making money.
Absolutely.
But then
Absolutely.
they're paying more tax, aren't they?
They do, but
Exactly.
there's nothing wrong with paying
Win-win.
tax if you're making money.
Mate,
Adrian.
true.
Yeah,
True.
I've heard
That
that
is
one.
very true.
Let's make money first.
Well, there is still positive.
I like that. Let's make money first. All right. So deductions. Can you talk to us about the sort of deductions and why are we allowed to have these deductions?
Well, to answer the second question first, is that we're allowed to have these deductions because the government lets us have these deductions through the Income Tax Assessment Act.
But what's the agenda there?
Stimulate, I suppose.
Look, this agenda is going right back to I think negative gearing came back in the 1930s. It's been around a long, long time, and I know from my understanding is that Australia is one of the few countries that has negative gearing aspects in it. But we know that in the late 1980s, the Labor government that was in power at that stage tried to quarantine negative geared losses, and it didn't work. It created a huge problem.
Yeah, 87, I think, 85 and 87.
To stop it, you mean?
Yeah, exactly.
Yeah.
They quarantined the losses so that basically in your income tax return, you only claimed a nil income, so a nil profit or loss on that property, and the loss carried forward to the next year until such stage that it made profits and it started to offset at that time.
Gosh.
But that's historical. That's going back a long, long
I'm
way.
glad it's historical.
Because that's useless.
But we know that at that stage it didn't work, and the negative gearing
But-
had to come back in.
Sorry to cut you off, but you just mentioned that they quarantined it, so they didn't actually eliminate it, they
No.
just held it back.
Correct.
I didn't know that. Oh, okay,
Yeah.
that's interesting.
It was never stopped. It was just to quarantine the losses, and those losses could be offset against future profits.
Future, yeah, right, I get it. Yeah. Okay, sorry, continue.
No, that's okay. And so really it's been around a long, long time. But now go back to your first question in relation to deductions. Look, there's a lot of deductions that we get, but the Tax Act says basically that any expense that you incur in relation to that rental property, you should be able to get an expense for, unless it's of what we call of a capital nature. And if it's of a capital nature, then it will be either added to the cost base of the asset, or alternatively, it'll be written off over a number of years. So a capital asset is things like replacing your fixtures and fittings, your stove, your hot water services, carpets, those sorts of items, and they get written off over a number of years. Your other types of expense that you normally get to write off are your things like your rates, your insurances, your repairs and maintenance, and of course the interest on your borrowings. Also, things like borrowing expenses, you know how you pay a loan application fee up front, they get written off as well, sometimes up front or sometimes over a 5-year period, whichever's the lower. The other things that we also look at, of course, is travelling expenses. If you're travelling to inspect the property, or you're travelling to collect the rent on that property, or you're travelling to repair that property, the expenses that you incur on your motor vehicle are deductible on on either a per kilometre basis,
Just to have a look
or if you want to keep a logbook and work out the total kilometres that you're travelling, you can always do it that way as well.
So it pays to have an investment property in Broome.
Yeah, keep going.
As long as you don't go up there for a holiday.
Holiday, right, fair enough. Okay.
Wow.
Thanks for that. Now, let me ask you this. Do you think there are people in the world, or mums and dads in the world, that do their own accounting, their own tax returns or whatever, that really they should be using a professional accountant?
Look, absolutely. It's so easy to miss expenses that you are legally entitled to claim. And one of the main things that you find that people always forget to claim properly is things where they take additional borrowings against home loans. They forget about using that additional borrowing, the interest on those additional borrowings as a deduction.
Oh, yeah, of course.
So, you know, in most of your structures is that people will use the equity on their home loan and have another loan, and they'll always claim the interest on the second loan, but not on the initial equity. And that's a tragedy, because quite often that makes up 20% of the purchase price.
Yeah.
I thought you
Property.
did this every day. They don't do that. They have to Google, they have to do
Yeah,
this, they have to
correct.
search.
Correct.
They still get it wrong.
Exactly. And the other thing is, you know, like we were talking before about the quantity surveys, you know, people forget that there's some really good deduction available in relation to the write-off of your fixtures and fittings of your home and the building allowance. So even if you do have a 20-year-old home, there are still good deductions available, especially upfront deductions for equipment that's worth less than $1,000, because you get an immediate write-off on that.
Oh, wow.
Is that a depreciation or
Correct.
a deduction? A depreciation, yeah,
Yep.
okay.
Time's running away from us, and I've still got a couple of questions for you.
Fire away, Greg.
Quickly, how do you handle your customers? What's your process?
Our process is that we'd like to sit down and work out with our clients, first of all, do they have a savings plan intact? And if they do, what is their surplus between their income and expenses? So what we want to know is, do you have enough surplus income to meet that budget, that geared shortfall that we were talking about at the start of the segment? So we want to make sure that if there's going to be a negative geared loss of $100 per week, that you've got surplus income to meet that $100 per week.
Right.
Really important thing. The second step of the strategy is to sit down and look at the client's assets and liabilities to see if they do have the right assets and the equity in those assets to be able to borrow. That's number 2. And then from there, we can basically provide our clients with an idea of the value of an investment that they can look at for this. So it's about saying you have X amount of equity in your assets, you have surplus income of this amount, so you should be able to borrow up to Y amount to go and buy an asset.
Fantastic. Dale, we've come to the end of our time. It's been great having you on the show, and I'm sure we have to get you back. I still didn't get to my second question, and it's a doozy. So I've got to have you back.
Look forward to it, Greg.
Thanks for having thanks for coming on the show and joining us. You've been watching the Mortgage Busters. We'll be back after the break with our finance guru,
Steve Hudson.
Steve Hudson. See you after the break. Welcome back to the Mortgage Busters show, and we're with Steve Hudson, our finance
Guru.
What was that about a nurse you were saying? Something. Just when we were off camera there, as Adrian started to tell
story.
me about a nurse. But anyway, I think we'll move on.
Yeah, well, I'm going to say banks love nurses, so they're very, very good for when you're doing a loan.
And police.
Yes, and police, yes,
police.
fireys, all
We love
all
our
those.
fireys, we love our police.
Yeah.
Steve, what do you have for us today?
Well, look, what a week it's been. You know, the 1,000
So you're
day
getting calls as well?
mortgage busters challenge. It's been brilliant. It's been flat chat. So well done, guys, for putting that onto the show and giving your viewers
well
an
done. You
opportunity.
actually
So
helped
Yeah, it
us
was
out.
a group effort. Group effort. So keep, if you're watching the show and you're not exactly sure what we're talking about, we were talking about nurses, but now we're talking about the 1,000-day mortgage buster challenge. We had Chris Bondon here a few weeks ago. He's a gentleman that he made it his mission to pay off his mortgage as quickly as he possibly could, and he did it in 973 days.
Only.
So we're giving you extra time. We're saying to you, do it in 1,000 days or under. Is it possible?
of course it's possible.
Of course it is.
And if it's not possible for the whole lot, we will design it to take it down to a level that's comfortable with a slight challenge, a bit of a stretch. So after 3 years, 4 years, 5 years, whichever you want to commit to, that you've got a mortgage that's really manageable.
Manageable, and
Yeah.
you've got some goals set that are achievable. You can reach them and start growing your finances so that you can be well looked after later in life.
Yeah.
How's that sound?
Great.
What have you got for us today?
Dale, backing up to what Dale said, let's have a look at
Very good.
investment. We're all about reducing your mortgage. That's what the show's about. But we're also looking at opportunities to do wealth creation too. And that's what Dale was talking about, the
Yes.
emphasis on how you can claim certain things from the government on your tax return. So let's have a look at how you would structure that from a finance point of view. Because it's very important. Elizabeth Jackson was on a couple of weeks ago or
Yeah,
last
that's right.
week.
Good.
One of the catch cries she said was trying to shove your investment property when you buy it into your financial situation. Get your financial situation right before you go looking. So the first part of being investor
That
ready.
is so true.
Makes sense.
People will decide that they want such and such a property, and they'll go and they'll choose it and they'll sign a contract or whatever. And it's exactly what you said that she said, that they have to shove this property into their existing finances when it should be working the other way around.
Absolutely.
It's a great point.
So if you're going to look for an investment property, you should have a pre-approval already done for the amount that you wish to invest for. So
Correct.
then you're not shuffling for shillings at the last moment.
Correct.
As Elizabeth said, trying to fit that in. So let's have a look at the
Is
structures.
the whiteboard involved?
Yeah, whiteboard's
well, here
involved.
comes the whiteboard.
Lucky no one stole the whiteboard.
I'll tell you what, if that happens 1 week,
We'll be in trouble.
Well, my segment will be
It'll be on the
devastated.
green board.
So look, as we know, we've got our own home, which we have been referring to our PPR, principal place of residence, and then we've got investment. Okay, so, and this is where all the tax deductions are that Dale was talking about, and you can have as many of these little houses as you like, or properties. So with the bank situation, there's an opportunity to actually take a loan of 100% across this property here. That's your investment. And I'm not a tax advisor, that's what you got Dale for, but from a investment claiming 100% is better than 80%. So
Absolutely.
So if you've got
So what you're saying there is, if that property's $400,000 to buy, it means that you're borrowing $400,000.
That's
the
right.
full amount, 100%.
Okay, so
yeah.
let's put $400,000 there. So, so from a bank perspective, they like to have this scenario. This is what they have best practice. Okay, is at least 20% deposit or equity, and an 80% loan. If you change those ratios, and we've talked about this before on the show, to say 90%, 10%, we've now got low mortgage insurance. Okay.
Now, just for the viewers to be really clear, with that 400,000, you're talking about 80%. In other words, you'd borrow 320,000, and you'd have 20% cash deposit. So you'd have 80,000 cash or 80,000 equity.
That's right.
Yeah.
I know. So, whoops, that's dollars. K's for thousands.
Yep.
So in this scenario here, we're talking about an 800,000 combined equity, right, or value, estimated market value of those two properties together.
Yep.
So on an 800 situation, if we're talking about 20%, we'd need at least $160,000 equity.
Equity,
Okay.
yeah.
So on that property here, you would have $160,000 equity with a mortgage of, $240,000. That's how it would work, where you would be trying to get a 100% loan on that. It's probably slightly more because you've got
Purchase
costs such
costs,
as
yeah, but don't worry
stamp
about
duty.
that.
We're not going to go into that detail, but the theory is that you want to keep it for 100%, and that's called cross-collateralisation. Where cross-collateralisation becomes a situation where it can become costly is where you only have 90% against 10%. And then you're into LMI, and you're paying then LMI across the two loans.
LMI, which is
loan mortgage insurance.
loan mortgage insurance.
So
Yep.
with a situation with this part here, this is best practice as far as a bank goes, you can actually structure it up where you do own 80% and 20% on that, and you can do it as 80% and 20% on this. And it's not cross-collateralised, it's standing individually by themselves.
That's in a SMSF, is it?
Well, in a Smurf situation,
Yeah.
in a SMSF,
Has
yes,
to.
correct. That's the minimum, right?
Yeah.
In some cases, they want 30%, depending where the property is and so forth. So from that perspective, this is how investors actually go into an investment property without having to put any money into it from their own pocket. They're using the equity that they've built up in their own personal place residence, to use that equity to get into an investment
And
property.
99 times out of 100, that wasn't a planned thing. That just happened because the market's
Yeah.
moved, and then, you know.
At least
Well,
they did it.
with our chunking, we can actually accelerate that a little bit more. So you can see there's an opportunity there for our viewers to look at their financial situation to see if they could do something along that line. And as we know, that property actually doubles in Australia every 10 years, according to the historic records.
Yep.
Crazy.
Yep.
So, there's an opportunity for our viewers, if they want to look at their financial situation, to see if they've got an opportunity to look at investment property. We look at, at the thumbprint that you
Thumbprint
got.
report. So if you'd like to
Yeah.
follow through what Stephen has just described on
And
the
more,
whiteboard
And more.
and more,
And more.
just again go to our website, tmbshow.com.au. There's a section there that you'll see that you need to fill out, where it's got the thumbprint report. What does it say?
Yep, just fill it out and
Fill it out.
send
and
it off.
Send it off.
Or
and-
give us a call.
or even give us a call.
1300 TMB show.
1300 TMB show. Easy to remember. We can't make it any easier for you. Register your interest that you'd like to get your thumbprint done, and you'll get a call from us. Organise a time. One of us will come out, get your thumbprint done, just to see where you are in the scheme of things with this and what you can do.
And don't forget the
1,000
1,000-day
challenge.
Mortgage Busters Challenge.
You won't forget, because we won't let you forget. I mean,
They're not letting us forget.
you're not letting us forget. You're doing the right thing. So, Steve, not much time left for chit chat,
Yeah.
but again, we're running out of time very quickly. So, thanks very much for watching the Mortgage Busters show. We're loving your support. We're loving your inquiries. Stay tuned again, same time next week. Have a great week from Steve, Adrian, and myself. Thanks for watching the Mortgage Busters show. We get it.